All right, it looks like we're at time. I want to thank you all for joining us for the Around the Valuation World International for the February 17th, 2025 webcast. Before we get started with today's presentation, I wanted to go over a few housekeeping items. First, to obtain CP credit, you must answer all the poll questions that pop up on your screen during today's webcast. If you have a subscription to the AVW International webcast, you'll receive the CP certificates within 7 to 10 business days from today. If you have any questions during today's webcast, please use the Q&A feature, as those will be directed to the presenter. Go ahead and put the questions into the Q&A, but we won't ask the questions until the end of the presentation today, just because we have only 40 minutes for the presentation. And Federico would like some as much information as time as he can to present the information. Let's see. So these are our technical editors. We have Wolfgang Niest and Pratisha joining us today. Andrew Newman is also another editor, and Brian Jones as the advisor. For our lineup today, we just have a few moments for the GACVA news, which is business valuation news from around the globe. And then for our guest today, we have Federico Beltrame, for our expert insight segment on alternative cost of capital methods for listed or unlisted companies. And with that, I'm going to do a quick GACVA news topic. Just want to let everybody know that we do have a free webinar coming up on the state of the valuation profession that will be on February 24th, 2025 from 2 to 3 o'clock Eastern time, and you will receive 1 hour CPE. So the link to join that webinar is in your materials, so feel free to click on that or use the URL below. Click on that and follow the prompts to register for that webinar. And I just have a quick little message they want to play before we go on to the presentation. So just play this real quick.
Windy Street is a prominent outsourcing firm in India that offers a comprehensive suite of services, including valuation, financial due diligence, accounting, auditing, and tax. Founded 3 years ago, with a clear vision to provide exceptional services to professional and accounting firms, we now proudly serve over 15 clients. Our success is built on our unwavering commitment to the values of trust, quality, and people. Our team of over 150 skilled professionals is led by a highly experienced leadership team. We bring unmatched expertise and dedication to every client relationship. At Windy Street, we believe in putting people at the heart of everything we do, our clients, our team, and our community. We also prioritize complete security and a robust IT infrastructure, ensuring that our clients' privacy and data are safeguarded at all times. With Windy Street, you're not just a client, you're a partner in a journey toward excellence. Windy Street.
All right, and with that, I'm going to turn the time over to Wolfgang, who will get us started with today's webinar.
Yeah, thank you. Thank you, Chanda. And thank you, Federico, supporting this show today. Yes, Federico Beltrame is Associate Professor of Corporate Finance at the University of Udine in Italy. He graduated in economics and received a PhD in business science from the University of Udine. His main research interests are related to SME, cost of capital, and mutual guarantee credit institutions. He has published articles on today's topic, as well as a book co-authored with Roberto Capellotti and Gabriele Toniolo. Looks like, now you can't see this. 1 second. This magical.
It's the effect of the...
It's the effect. Estimating SME's cost of capital using a value at risk approach, the capital at risk model. And the book was the reason for me to look a little bit deeper in his publications, and that was the reason why we got in contact last year, because he published interesting insights on a different way of developing cost of equity especially for not listed companies. You all know we practitioners are using CAPM plus, modified CAPM plus, and maybe there are other thoughts from the academic view on these, and yeah, very interesting. Also, the relation to the banking sector. You also published a book on valuing banks, and you will see that both views, the banking view and the SME valuation view, it's maybe there needs a connection between both, because banks, yeah, they are rating SMEs every day, and maybe equity evaluators can learn a little bit from the banking perspective of risk and rating. Yeah, having that this, I hand over to Federico and look forward to his ideas on the topic alternative cost of capital methods for listed or unlisted companies.
Okay. Thanks. So we can start with the presentation. Okay.
Yep.
Thanks so much to give me the opportunity to be here to talk about a very important topic, a key topic in corporate finance, that is the cost of equity, the cost of capital determination. But today we will talk about a different way to estimate the cost of capital and the cost of equity as a whole. So it's very important to understand that in valuation, so it's not so easy to apply effectively the capital asset pricing model in each situation. And so for this reason, I try to elaborate new methods, new model to incorporate some kind of risks in the valuation. So I launch my presentation. Give me. Okay. So we can start with the agenda for today presentation. So it's very important for me to start with the problems of the classic methods, for example, the capital asset pricing model, or for example, the arbitrage pricing theory. So it's quite similar in some ways. So for this reason, I can start with this. Okay. And then secondly, I will move to the basic idea of the method to incorporate some specific risk in the valuation. I call this method the totally levered approach, because we will go to see that in order to calculate the cost of capital and then the weighted average cost of capital, it's important to make some assumptions. So it's very important first to start with the theory behind the model. So, and then we have to decline this theory in two different kind of situation. That is, from one side, the cost of capital determination in the listed companies. So in listed companies, we have some information that we don't have in the SMEs, for example. But first, that is more simple. We will go to apply. We will go to see how the model works for listed companies first. And second, we will go to try to apply this model to understand how to calculate the cost of capital for small businesses, for unlisted companies. That is more important, even more important. This model, and then the third step is to understand how in practice to apply this model, in particular for a small business, for example. I made some search, some academic research about the rating systems. So in all the view of this model, the rating system, the bank's rating system is very important. In Italy, we have an open source in order to simulate the bank rating, for example. We have the rating of the guarantee fund. And with this rating of the guarantee fund, we are able, inserting the balance sheet and income statement data, we are able to determine the probability of default. So, but for this model, we will go to see today, for the totally leveraged approach, we need, obviously, the probability of default, but we need a special version of the probability of default, that is the probability of default for a totally leveraged firm. So we will go to see this key and very important point of the model using this rating system that is free in Italy. Then we move lastly to an example of this, and then we will go to understand, to analyze some strengths and weaknesses points of the model. Okay? So, first of all, the problems behind the classic methods. The classic methods, for example, the capital asset pricing model. I split those problems in the two parts. The first part is valid for all the firms, in my opinion, because it's valid both for bigger firms, but also for smaller firms. What are the problems of capital asset pricing model and other systematic risks model? I don't know, fameux French, arbitrage pricing theory, and so on. But in particular for the capital asset pricing model, that is the most used method. The first problem is that in a particular situation, we need to price not only the systematic risk. For example, you know that valuators and practitioners in some situation usually to add plus like we see before, we usually to add some risk premiums to incorporate some specific risks. But how much are those specific risks? In which way we are able to translate the risk in the premium, in the risk premium, is not so easy. So a specific risk is to add to the capital asset pricing model 1%, 2%, 5%, I don't know, because this is valid for one country or, for example, for one sector. So it's not so easy to understand the dimension, the size of those kind of risk premiums. And so for this reason, with the model, we will go to see, I try to fill this gap and define a specific risk that is valid for a specific firm. For me, this point is very important. And for example, another problem, the third year, because the second, the specific risk, as we have seen before, is arbitrary. And so for this reason, we need a more robust system in order to include specific risk. And one another point that is important in general, the problem regarding the estimation of the market risk premium. How to include the counter risk premium, for example. This is a very important point. Or, for example, what kind of beta we will go to use? I don't know, the total beta, or, for example, an adjusted beta, or, for example, a raw beta, or, for example, do we use the weekly, for example, returns, or monthly or daily? So those points are very important because we can move our estimation in several directions. So it's very important. Okay. And for example, a last point regarding in particular the case of unlisted companies, the case of SMEs, the problem that the comparable approach, because we know that if we have to analyze to estimate the cost of equity for an unlisted firm, we use a comparable beta, for example. But the comparable beta of listed firms is affected by the operating risk and the financial risk of listed firms that can be very different in respect of small businesses. We have a degree of operating leverage and of financial leverage very different between bigger firms, bigger and listed firms, in respect of non-listed firms. So it's very important to analyze, to go deeper into this point. Okay, so those are the problems of capital asset pricing model. Okay, and in general, in order to overcome those points, I try in the year in my academic research to elaborate new methods in order to fill those gaps. But the method we'll go to see it's very important regarding the method to start from the basic idea, the theory behind the model, and then go to apply effectively this method and the idea behind the model. So, second point, what is the conceptual framework of the model? The conceptual framework for the model starts from the Modigliani and Miller theories. So obviously, Modigliani and Miller theories have some important assumptions that are rigorous in theoretical terms, but here I will start with the Modigliani and Miller theories with no taxes. But it's not a problem, the taxes, because we can extend this model with the same results using taxes, so including taxes in our model. So for this reason, in order to be simple, I start with no taxes situation, but we can extend with the same results, so it's not a problem. In particular, we have two important aspects to introduce. One side, we start with the Modigliani and Miller with no taxes, one. And second, we assume that our debt, the firm financial debt, is risky. So for this reason, the cost of debt is not flat over and over the leverage value. So for this reason, the cost of debt will be not flat, but it will grow in respect of the leverage effect. So, for example, if we have to here to understand graphically a situation about what I will go to see. So, for example, the logic is that we have that in this graph, this is the cost of capital. In this axis, I will go to measure every version of the cost of capital. And here we have the D/V, that is the leverage of the firm in market value, obviously. So the logic is, if we have Modigliani and Miller with no taxes plus the risky debt, apparently those kind of situation are not in line together, but it's not a problem because we have some corporate finance and theory texts that claim that we can have Modigliani and Miller results also with the risky debt. So basically, the risky debt is not a very important problem. Okay, so for this reason, we can assume a risky debt maintaining valid the same results of Modigliani and Miller. So for this reason, the logic is that the cost of capital, the unlevered cost of capital, because we have some cost of capital version, we have the cost of equity that is affected by the leverage, we have the weighted average cost of capital, and then we have obviously the cost of debt, but also we have the unlevered cost of capital. The unlevered cost of capital is the cost of equity with no financial debt. That is no sensible, that is no affected by the leverage effect. Instead, the cost of debt is, this is the unlevered cost of capital. The cost of debt starts here, for example, because for an unlevered situation, the cost of debt is obviously lower in respect of the cost of capital, the unlevered cost of capital. But with the risky debt, we have first that the cost of debt is flat, and then starts to grow until the cost of capital value. So this is the behavior of the cost of debt. And when we have that the D/V is equal to 1, all the debt holders maintain, all the debt holders have the same risk, the same operating risk of equity holders. So the idea behind the model is that when we have a totally leveraged situation, a totally leveraged situation is when we have that the leverage D/V is equal to 1. So, for example, if we have that D/V equal to 1 is if D/V is equal to 1, we have that the cost of debt still grows until the cost of capital, the unlevered cost of capital. But this is also we can demonstrate also this using the classic weighted average cost of capital formula. For example, if we have Modigliani and Miller with no taxes, we have that the weighted average cost of capital is equal to R0, the unlevered cost of capital, and we can see that using the classic weighted average cost of capital, the formula is this, that express the weighted average cost of capital. If we have that this is equal to 1, obviously this is equal to 0, and for this reason, when we have that D/V is equal to 1, the weighted average cost of capital is exactly equal to RD. But this is a special version of RD. This is an RD with this DOV equal to 1. So for this reason, this kind of RD, we can call this type of RD totally levered situation. So in a totally levered situation, DOV equal to 1, the RD is exactly equal to R0. So the basic theory behind the model is just this. It is sufficient to calculate the RD under this specific assumption to have R0, to have the unlevered cost of capital for investment project and firm valuation purposes. So for this reason is very important to start from the cost of debt. And one another important point of the model that we have at both R0, the unlevered cost of capital, and RD, the cost of debt, are in the same framework. Because one problem about the capital asset pricing model is that in the classic valuation, when we calculate the weighted average cost of capital, we have RE using capital asset pricing model and RD using, for example, rating. We have two very different frameworks. Instead, with the model that we'll go to see deeper after, we'll go to see that we have exactly the same framework. And so we guarantee some important points regarding the simulation and the exact calculation of this references, cost of equity and the cost of debt. So I come back to my presentation. Okay, here. So, for example, here. Okay, so this is exactly the same thing that we will go to see that we have seen before. So, for example, here we have the weighted average cost of capital. Very important thing. This view is not only my view, because other researchers, other practitioners, but in particular the professor, share this view. For example, here, Copeland, Turner, and Salomon think and demonstrate that for a fully leveraged situation, for extremely high leveraged situation, the cost of debt is quite similar to the unlevered cost of capital. So this is the logic behind the model. Now we have to apply this logic practically in order to understand how to calculate the cost of debt in a totally leveraged situation, both for listed and unlisted companies. So first of all, the next step is to analyze, to show you how to calculate the cost of debt in this specific situation for a listed company. For a listed company, we can use some pricing model, some debt pricing model, but here I use the most common, that is the Murder model. So in order to calculate this specific situation of cost of debt, the totally levered situation, I will go to use the classic Murder model. Okay, so Murder model has some equation in order to calculate the equity, in order to calculate the equity standard deviation, and we have also some important equation regarding some variables that we have to include in the model, D1 and D2. But here is not very important the logic behind the murder model, because we have it's a very long story, and so for this reason it's a very important story regarding the murder model, and the murder model is used in the financial market very commonly. So for this reason, it's not a problem of murder model, but in general, we know that from the murder model, we can obtain the credit spread. We can obtain the cost of debt. So for example, from murder model, we have the yield. We have the yield for debtors, for third-party lenders, for example. So we can calculate, starting from the risk-free rate, we can calculate the cost of debt. So this equation is just to understand the behavior of the cost of debt that is increasing in the leverage effect. So here, this is the leverage effect. Okay. But if we assume that the present value of debt is equal to the fair value, we have the D on V ratio equal to 1. That is the basic assumption of before. So in general, if we take this and we assume that the value of the firm is equal to the present, because in the denominator here, G times the exponential effect is for obtaining the present value of that. So in the denominator, this is the present value of that. So if V is equal to the present value of debt, we have the leverage ratio is 1. And this, replacing also in correct terms the D1 variable and the D2 variable, we can obtain from this with some simple steps. So it's not difficult. We can take this, we can replace here this, and we can obtain the yield. We can obtain the cost of debt in this specific situation when the leverage is equal to 1. So in this specific situation, we can obtain the cost of debt in a fully leveraged situation that corresponds to the unlevered cost of capital using this simple equation that is just depending only from the standard deviation of assets. So it is very important to note that in this equation, we have no the degree of leverage. So the unlevered cost of capital is just depending from the firm risk. And the firm risk, we can express the firm risk using the standard deviation of assets. So higher is the standard deviation of assets, and higher is the cost of capital, the unlevered cost of capital. So the equation is perfectly in line with the purposes to have an unlevered cost of capital that is not depending from the leverage effect. And this is valid, this holds for listed companies. But in the case of unlisted companies, how this model works? It works using a rating system that allows us to have the probability of default. So it's very important to have the probability of default in order to apply, in order to translate the method for unlisted companies. But the logic is very similar. For example, if we have to calculate, if we have to estimate the cost of debt for non-listed companies, we can use this. This is here in the center of this slide. This is the risk neutral framework. So we can calculate the cost of debt as a risk-free rate plus a credit spread. Probability of default times loss given default is the credit spread. The denominator is just only to scale the effect regarding of the debt net of default effect, net of default risk. So, but it's very important, the numerator. The numerator is tell us that the cost of debt is just depending from the risk-free rate, the probability of default in the till the 1 year, using the horizon of 1 year, and then is depending from the loss given default, that is the loss of the capital for third-party lenders. So it's a percentage between 0% to 100%. Okay, so in general, if we use, like for example, the banks, a risk-neutral framework, we will see that the cost of debt is equal to risk-free rate plus this is the expected loss rate, probability of default times loss given default, divided by scaled from the net value of debt, that is 1 minus PD times loss given default. Again, this is valid for the cost of debt. But what about the cost of capital? What about the cost of debt in a specific situation when we have that the leverage is extreme, when we have an extreme value of leverage? We can use this. We can estimate the cost of debt in a very specific situation that requires the probability of default in this specific situation. That is the probability of default of a totally leveraged firm. So the key point is to estimate, is to move from the probability of from the classic probability of default to a special case of probability of default for extremely leveraged situation. Okay, and for this reason, it's very important to charge some specific financial highlights. It's very important to charge some balance sheet and income statement highlights to obtain the probability of default in an extremely leveraged situation, in a totally leveraged situation. So, from one side, we have the cost of debt. We can obtain the cost of debt using the classic probability of default. In order to have the classic probability of default, we can use a rating system. We can insert, for example, balance sheet and income statement values inside the rating, and the rating give to us a score, and with the score, together with the score, the rating give to us the probability of default. This is the mapping the mapping between the rating, the score, and the probability of default. So in a very similar way of banks, for example, we incorporate, we give to a rating system balance sheet and income statement, and the rating system gives to us the score and the probability of default. This is valid for the cost of debt. If we want to calculate the cost of capital, namely the cost of debt for a very extreme situation, we have to insert in the rating system a rearranged specific balance sheet and income statement. We have to refresh the values of balance sheet and income statement in order to represent the fully levered situation. So basically, the first point is to have a specific fully levered balance sheet and a specific fully levered income statement. Putting this data into the rating system, the rating system gives to us, of course, a probability of default, but a specific version of probability of default, that is the totally levered probability of default. So the key point for a non-listed firms is to insert in the rating system a specific data, a specific financial data, in order to simulate a extremely levered situation. I can do this in Italy using, for example, the rating of the mutual guarantee fund. I can insert in this kind of rating, that is an open source in Italy, the balance sheet, specific balance sheet, and the specific income statement in order to represent a totally levered situation. So it's sufficient to insert in this rating, in this logic, a specific balance sheet and the income statement with those assumptions. What a totally levered firm presents. For example, the equity amount is equal to 0. So in order to simulate, in order to represent a totally levered situation, we have to move all the equity in the debt category. So we have to translate what we have. So the amount of equity we have in the equity item, we have to move this amount in the medium long-term debt. Why medium long-term debt? Because the equity is a stable source of financing. So for this reason, in order to not alter the match between assets and liabilities, it's very important to simulate a debt situation, a totally debt situation, but maintaining the mix between the assets maturity and liability maturity. So, for example, the first assumption is to move the equity from equity to medium long-term debt first. And I move just to the third assumption. The third assumption is to move all the short-term debt to the long-term debt. Because if we want to simulate the unlevered cost of capital, the unlevered situation, because we have a sort of equality, the unlevered situation is equal to the totally levered situation. Those risk positions are quite similar. the operating leverage is more or less the same amount between third-party lenders in a totally leveraged situation and equity holders in an unlevered situation. So for this reason, in order to not alter the logic behind the equity is a stable source of financing. So we have to translate all the short-term debt in the medium-long-term debt. This is the third. And the second assumption, refreshing the balance sheet and income statement, we have to refresh all the income statement. We have to put that all the EBIT, the earning before interest and taxes, is equal to the interest expense in order to charge all the variations, all the volatility of interest expenses on the earning before interest and taxes. So it's very important that all the risk is charged by the earning before interest and taxes. So those are just refreshing points, just a way to refresh, to represent the totally leveraged situation into the balance sheet and income statement. So basically, if we use the classic, the normal balance sheet and income statement of a firm, we can obtain the probability of the firm. If we use the balance sheet and the income statement with those modifications, with those refreshing points, we obtain just a very special version of probability of default. That is the probability of default in the totally leveraged situation. I provide to do this exercise using the mutual guarantee fund rating. The mutual guarantee fund rating, as you can see here, provide some score. So the logic is quite similar to a Altman Zeta score. So the logic we calculate using differently from sectors, for example, we obtain a score. So, for example, several balance sheet and income statement ratios, we obtain a score basing to the ranges of those scores, of this score. For example, we obtain first the rating and then the probability of default. If we charge the special case of balance sheet and income statement totally leveraged situation, we can obtain the rating and the probability of default of the totally leveraged firm. And one important point is that for the mutual guarantee fund rating, the loss given default is usually more or less quite similar to 100%. So for this reason, the estimation of the loss given default is not an important point, because we can assume here that the loss given default is more or less equal to 100%, because the logic is that when the firm goes to default, the recovery rate is more or less near to zero. And so for this reason, the loss given default is more or less close to 100%. So for this reason, the key important point is probability of default. For example, here is an example. So for example, we have sector 1 here is the industrial sector, for example. I charge all this data, that is the original data of the balance sheet and income statement, in the left column. In the right column, we have instead the totally leveraged situation. So the total assets and the items of total of the asset are the same here, left and right. But for example, here, regarding the liabilities, we have no equity in the totally leveraged situation. All the financial debt is a medium long-term financial debt, and working debt still remain the same, obviously. And then lastly, the other assumption, the interest expense are different, because here we have the real amount of interest expense, and here instead we have an amount of interest expense equal to earning before interest and taxes, in order to charge all the risk effect on the debt holders. And assuming, for example, 3.51 as a basic rate, as a risk-free rate, here we can calculate the probability of default, that is 0.12%, and here we have the probability of default for a totally leveraged firm. So 0.12% is the probability of default with the left side data, left column data. The 8.45% probability of default is the probability of default with the right side data, this. And using the first, we can obtain the cost of debt using this equation, this in particular. Using this equation, we can obtain the cost of debt, and then the cost of capital, the unlevered cost of capital. So clearly, we have a very important spread, because one thing is the cost of debt, and one other thing is the unlevered cost of capital. So for example, if we have to discount the cash flows, the firm cash flows, we can use this, the 13% of the unlevered cost of capital, for example. So the basic idea is that the cost of capital is just a special case of the cost of debt. This is the theory behind my model, that is the totally levered approach. Last things, we have some important strength points of the model. We can incorporate the specific risk in the cost of capital, for example. We can reduce the ranges of estimation, for example. And in particular, we are able to apply the rating not only on historical data, but also on forecasting data. So for example, in order to estimate in the forecast, in the first analytical period of valuation, we can use, for example, a different cost of capital, different references, in order to represent each year a different degree of operating leverage. Obviously, there are some weaknesses. I use this kind of rating. For example, I use the guarantee fund rating. But in order to make a more specific, a more robust calculation, we can use the banking rating. But unfortunately, it's not an open source. So for this reason, I prefer here to use the guarantee fund rating. Okay? So This is my presentation, and if you want, we will go to see some questions of. I don't know if Wolfgang, you want to tell me some question, or we will go to see together. For me, it's not a problem.
Okay, thank you, Federico. Just for the audience, I send a link through the chat box on one of the papers from Federico. Yeah, do you have any questions on this idea from Federico?
Yes.
Questions or some notes?
It is a system that we have to use, largely use, and then of course we can have some, I think, some remarks, question, and so on.
There is one question in the Q&A, very interesting, thank you. How does the TLA model compare with the use of a debt beta based on ratings? Do you have any experience?
Regarding the debt beta?
Debt beta based on ratings.
Okay, the debt beta is, we use the debt beta in a different framework. So for example, the logic is that if we are into the capital asset pricing model, so we use the debt beta and the equity beta, of course, but here we add in a very different framework. So for this reason, the cost of debt, we don't take the cost of debt from a beta, and we use the cost of debt from the model. But of course, the logic is that we can use, instead of a murder model, also a debt beta. But we have to see the firms that very indebted. And for the firms that are very indebted, obviously, of course, we can use the debt beta in order to simulate the unlevered beta. So this is very similar, but unfortunately, we have to use the market data, the firm market data that is not so easy to have for a listed firm, a very indebted firm, because in general the listed firm presents a higher amount of equity. So for this reason, it's not so easy.
Yeah. Thank you. I think that's a great concept from Brian. I have one question. The most important point I understand is to find a probability of default in this special situation of 100% leverage.
Yeah.
So you are using, or you use the guaranteed fund rating in Italy.
Yeah.
Because it's an open source. Do you think, for example, from a German perspective, if you have a German SME looking into these data from Italy, there could be a country risk portion?
I tried to search the same data in other countries, but it's not so easy, because in general we have that the rating systems are closed. So for this reason, it will be very important, very useful for each country to have an open rating in order to have the probability of default. I don't know, in United States, we have a risk calc, but it's not open. And for this reason, the last resource is, I think, to talk with the banks, because only the banks can, I think, perform a rating with all the steps that is required. But unfortunately, I don't have ideas regarding German market or United, or for example in English market. It's the one other problem regarding the model, because we have to use a rating that is free or is a lower price, for example.
Yeah, I understand.
Can be my future research to understand.
Yeah. So I'm aware of some rating models in Germany as well. Some synthetic rating models. Some valuators try to include such a synthetic rating into their valuation models as well. But I'm not 100% sure what will happen if we include these 100% leverage effect.
The problem is that we have we must have a real rating, because for example, in one of my publication I try to use the zeta score of Altman, for example, in order to include this effect, but it's not the same way. It's not the same effect. So for this reason, also the modern give us a synthetic rating, but it's too synthetic. It's, in my opinion, is not work so well.
Okay. Good. And we need ratings for SMEs and not for bonds. That's another.
Yeah.
Okay. Pratik, do you have any thoughts?
No, I think I'm absolutely good, and would like to thank Professor Federico Beltrame for an amazing session today. I would also like to thank all the participants who were part of this session. With this, we would wait for the next session, which is on March 24th, 2025. Thank you all, and have a great day ahead. Thank you. Thank you.
Thank you
for the opportunity to be here. Thanks a lot.
Federico. Great. Thank you.
Bye-bye.
Bye.
Bye.